And the
Yeah.
other thing is not everyone has the time to read and learn and, and study all this stuff. That's why you have to turn to experts, turn to people you trust, turn to people that have done it before, that have the experience, that have the track record. We've done a lot of it. There are other people that have, we're not so unique. We're not the only people doing it. There are a lot of people doing what we're doing, but reaching out to people like us, we're always willing to talk to people, reaching out to other people that are doing this and saying, hey, look, what do you guys think about this time to invest? Why would you invest now? Or would you hold on to your capital now? Those are questions you should ask experts. And that's another point. I wish I spoke with somebody, even if I didn't have the knowledge, spoke with somebody in the know, knew of someone that had that real estate knowledge that I could talk to, or even knew enough to refer me to the right person.
Welcome, everybody, to a new episode. In these uncertain times, the economic landscape seems to shift beneath our feet almost daily, right? The market volatility, rising interest rates, and unpredictable geopolitical events are painting a rather grim picture, making the idea of investing now feel more akin to navigating a ship in a storm without a compass. It's almost as if, the safer choice is to hold on to what we have, to weather the storm with relatively safe cash reserves, despite the call for potential gains whispering that fortune favors the bold. For those of us watching the market's unpredictable swings, the fear isn't just about losing money, though. It's about the potential impact on our families, our ability to provide, and our future security. But while those fears are understandable, especially in the turbulent times, it's crucial to really dive deeper and challenge those apprehensions. In the next segment of our podcast, we'll explore why these fears, though valid, may not be as well-founded as they seem, and why opportunities for growth and security still exist within the chaos. Today, we're joined with us by none other than Ravi Gupta, co-founder and COO of Viking. Welcome, Ravi.
Thanks, Nathan. Happy to be here.
Always. So let's dive into it. Can you give us kind of a personal example of a time where you might have felt fear or where kind of fear might have paralyzed you from moving forward?
Yeah, absolutely. This is a very prevalent feeling amongst many of us who are investors, and you're always worried about what will happen. Will you lose your money? There's volatility, as you mentioned in the introduction. There's geopolitical turmoil. There's so many reasons why you shouldn't invest. And I'll tell you a story about one particular property I had and why I decided to invest at one time and decided not to invest at the wrong time. So this was back in 2008. Actually, maybe it was 2007, 2008. The economy was peaking. Everybody was super interested in investing. And that's when people want to invest, right? Everybody else is doing it. So you want to do it as well. You want to get in. So there are my father and I were flipping these single family homes, which was very risky. We were just hoping that there is organic growth that would give us profits and then we'd flip and then hopefully cover our closing cost expenses. And we did it once. We made like 30K. We gave each other high fives and we're like, oh, let's do it again. We saw another one. It was a new build house, $875,000 in Loudoun County in an area that was just recently developed, not much going on there. It was just astronomically insanely expensive for what you got. At that time, to build a home, now that I know about building, I didn't know it back then, but to build a home like that probably would have been about at most like 350K. The land was probably, 25K at the time when they bought it. So these builders were making an insane profit. But people were purchasing these homes, and there was actually, in fact, a line outside waiting to buy these homes. I remember like waiting in line. Everybody was waiting to sign their name on a contract to get one of these homes, and you weren't guaranteed you'd even get one. And if you were lucky enough, they'd call you and you'd get one. So we unfortunately got selected, and we thought we were fortunate at the time, but we were like, oh, awesome. We got in, we signed it, got this home under contract, 875. The economy was sort of peaking. We could see over the edge at that point, like before we were closing. And I remember thinking, oh man, maybe we shouldn't even close on this. But, we were so locked in at that point. We just went with it. We ended up closing and then we tried to flip it. We had one person interested at 850, like for maybe like an hour. He was thinking about it, then he backed out. And then we had multiple open houses. People were like, maybe 825, maybe 800. It got to the point where those properties were worth about 550. And some were selling at this. People were just like, I'm scared, I'm getting out of this. So that's the opposite, right? Like when everybody's doing it, you want to do it. When everybody's scared, you want to sell and just, and that is where you lose money. That's where most people lose, is they follow their emotions. So the emotion was at that time, hey, let's sell everything. So there are people selling for like, 500. Actually, even one house transacted for like a little above 400,000. People were taking huge losses in that community because they just were so fearful. And we ended up deciding to hold on to that property, and we just rented it. And it was a losing endeavor. But also at that time, I was like, there's no way I would buy. I was like, there's no way I'm buying anything here. I was scared of what I had. I was scared that I was going to lose even more. I just wanted to rent what I had, and that was it. The
Mhm.
funny thing was, if I actually got over my fears and actually bought at that time, I would have made a killing. I mean, I could have purchased at that time like probably 3 or 4 different houses in that neighborhood, rented them, and sold them very soon afterwards for a very nice profit. But anyway, ended up holding on. Thankfully, things came back a little bit, still sold for a pretty massive loss. If I held on to it now, it'd probably be worth over $1 million. But I ended up selling, I sold it like a few years, probably 5 years ago. But that's what happens, right? We sell based on the overall prevalent emotion. Like if everyone wants to buy, we're buying. If everyone wants to sell, we're selling. We don't sell in logic, and that's the key right there. We got to look logically at where we are now, make a decision logically, and get emotion out of it.
Yep. And that's the whole part of investing. I feel like, a lot of the fears stem primarily, at least when they start off, is a lack of knowledge, a lack of knowing kind of what investment opportunities are out there. There's a lot of, hindsight's 2020 looking back. I'm sure any real estate investor, I feel like, is like, hey, if I would have known this market was what it's going to be today 10 years ago, I would have bought up half the town by then. But it's good to kind of just at least know, hey, what are the investment options out there? When people think of investing, it's a lot about stocks and bonds and ETFs and mutual funds, but there's a real kind of lack of clarity, I guess, around kind of what investment options are out there. And so you kind of sit, in your little safe haven and not really move forward. You ever heard that the term burn the boats?
Yeah, burn the boats. Yeah, yeah,
Yeah, yeah. So
absolutely.
there's this Japanese warrior who had these, a bunch of warriors on this beach, and they all kind of looked back at the boats that they just came from, and he said, hey, he commanded his archers to light up their arrows on fire and burn the boats that they just came from. And
Can't go
essentially,
back.
the analogy was that you can't go back, right? So
Yeah.
that's the whole point. At least when you got to jump in there with 2 feet and say, hey, there's a security of a W-2 job, there's a security of having a 9 to 5, but that's not going to get you to financial freedom. It's not going to really allow you to grow wealth. You really have to jump in and say, hey, I know I don't know a lot about investing, but at least start somewhere and start kind of that journey.
Yeah, and I would add some to that because yeah, you can burn the boats, but if you're like burning the boats and you take a few steps and you get shot, somebody puts an arrow through your chest, you're screwed. You're dead.
Yeah.
But like you want to make sure that you have the knowledge to know that, hey, look, I have, I know what I'm doing. I know what I'm getting myself into. So going back to this example, in hindsight, if I had the knowledge of market cycles, if I knew that there was, such thing as a market cycle, and how this is a consistent event that happens every so often, like every, what is it, like 8 to 10 years or so, there's ups and downs, and it's a boom bust cycle. It always happens this way. If I knew that, if I knew real estate very well, like I know now, I knew that, like, hey, this is the risk. I am buying a turnkey property that really has no value add, and I'm trying to flip it just based purely on organic reasons, or organic appreciation instead of forced appreciation. If I knew that concept, that would have made a difference. If I knew the market itself and knew that, like, this is not a good area because there's not a lot of traffic coming through, that'd make a difference. So there's so many different ways. Like if you start checking those boxes and knowing all the
Mhm.
things that are happening around there, you can make an educated decision. You can really, be like, hey, look, for example, in that same time, if I was like, you know what, instead of buying the single family home, I'm going to go to Southeast DC where there's a path of progress. There's like, there was like some new construction going on there. There's new construction. I'm going to buy a value add property with a very low cost basis. Even though it was like kind of peak market, you could still buy things very cheap there. I'm going to put a bunch of money in renovating it and add value to it. It's a rule of thumb. You put in $1, you get two out. It doesn't always work that way, but it's kind of some way to think about it. And if I did that and I did that at that same time, I would have made a lot of money doing that versus what I did before. So it's just that knowledge, right? And the
Yeah.
other thing is you can't always, not everyone has the time to read and learn and and study all this stuff. That's why you have to turn to experts, turn to people you trust, turn to people that have done it before, that have the experience, that have the track record. And we've done a lot of it. There are other people that have, we're not so unique. We're not the only people doing it. There are a lot of people doing what we're doing, but reaching out to people like us, we're always willing to talk to people, reaching out to other people that are doing this and saying, hey, look, what do you guys think about this time to invest? Why would you invest now? Or would you hold on to your capital now? Those are questions you should ask experts. And that's another point. I wish I spoke with somebody in the, even if I didn't have the knowledge, spoke with somebody in the know. Like knew of someone that had that real estate knowledge that I could talk to, or even knew enough to refer me to the right person. Like
Yep.
that's what you need.
Yeah, totally. And that's the thing is real estate's oddly cyclical, right? It's like one of the businesses that seems to always go kind of the same ebb and flows, even if the timeline shifts a little bit. Whenever there's up, there's going to be kind of a down, right? And so if you're able to really know kind of that one, real estate is cyclical. Two, know how to really identify the indicators of what kind of market you're in, if you're in a buyer's market or if you're in a seller's market and what's to come, then you really kind of position yourself to be at the front of the market, but you allow yourself to position yourself well against the market rather than just being kind of a victim of whatever happens in the market. I feel like that's a lot of like the investors when they first start off is, hey, I had this retirement account and, during the 2008, boom, it pretty much went to zero. And now I don't know what to do. I don't want to invest anymore. Right.
Right.
That's a good point too. When you're talking about, looking to experts, looking to those that are in the field. One of the things that I've kind of really made a commitment to, and I'll kind of preach it from now until to the day I die, is using AI to really kind of get ahead of the game, right? Literally in an afternoon, you can say, hey, what kind of market I am, what kind of market am I in, what's to come, and how can I best position myself for the future, right? Obviously, talking to the experts that are in the game, that are on the ground, has tremendous value. But if you want to take some control in your own hands, use ChatGPT, use Claude, use another AI, and just ask it questions about the market and allow yourself to kind of see what's to come. And that should inevitably, hopefully, remove some of the kind of emotion out of the process. But Robbie, can you talk about kind of the fear of losing money and how some investors can get around that?
Yeah, absolutely. So I think the way to go about this is number one, you calculate your net worth and take 10% of that and keep it in cash. And one of our mentors told us that. And I remember him saying that. And I was like, wait, that's, could be a lot of money if you have a reasonable net worth. Like, do I want to just keep that in cash sitting there? And I invested that money and I invested it in assets that aren't performing that well right now. And now that I look back, I'm like, wow, that made a lot of sense. So I think that is a minimum. Keep some money in cash and keep it sitting there. That's sort of your nest egg. That's something you put into CDs or some very stable type of investment. Once you get more than that, then you figure out, what kind of risk do you want to take? Are you looking to get massive gains and take a lot of risk? Are you looking to take less risk and maybe get less gains? And one thing about real estate, and something you'll commonly hear, it is one of the most asymmetric risk reward investments you can make, right? Meaning that you have low risk but high reward. So that it is certainly something. Real estate is something you should keep in your investment portfolio 100%. Absolutely, some kind of real estate investment. Now, whether it's through a syndication, through a REIT, through personal investments, whatever it may be, you should include real estate there. So that's some basics. To overcome fears, first you have your nest egg, you have your 10%, you have extra money to invest, and the question is where to invest it. And that's where you just talk to people that are in the know. Call people up, call us up. We're always open to the conversation. Call anybody else up that's doing the same thing. Ask them, hey, what do you think about investing? And you'll kind of get a sense after talking to them if they're trying to sell you on themselves versus telling you the honest truth. And I think one thing that I've learned over the years is you really want to have more of like a fiduciary type person on your side rather than someone that's just trying to sell you a product and trying to do it, for their own gain. So I would say, you should talk to these people, but then also have someone in the financial space to confirm that this indeed makes sense, right? Like a fiduciary to help just make sure that you talk it through and make sense to them. So that way, number one, you have extra cash. Number two, you're talking to people you're gaining knowledge. Number three, you're talking to someone that has baseline financial knowledge that you can run things off of, that you're paying, you're paying them for their services. They're not looking to gain from your investment necessarily. And then when you do that, that completely decreases, your feeling of risk, right? You kind of feel like you've made an educated decision, and then you go ahead and make that investment.
Yeah. And a lot of people will kind of focus on the risk of an investment a lot more than they will on kind of the return and the upside too, right? Something called loss aversion bias, where, we tend to, fear losses more so than we kind of feel the pleasures of gains. And so we'll do anything we can to kind of avoid pain or avoid losses that can lead to excess risk aversion, right? Especially when I was getting started on in kind of my early investment careers, I had a lot of kind of analysis paralysis where I said, hey, a lot of this seems risky. I don't know what I'm doing. I don't want to deploy any capital. And so I just kind of sat on the sidelines I learned a ton, but all that time, right, with compound interest and with what the market's doing, I could have been really growing my wealth and growing my kind of expertise. And even if you do end up losing on a stock or on a deal, or you lose your past investment, it's a terrible situation, but at least it's a learning experience that you can then build off of rather than just kind of sit on the sidelines. And that's, I think, recently too, is that a lot of folks have really haven't taken advantage of kind of the opportunity that is currently in the market.
So I would say, I mean, many of you have heard of dollar cost averaging, right? So what dollar cost averaging is you invest a little bit at a time, and then over a course of time, your investment averages. And if you look at investment strategies, for stocks, mutual funds, and that type, well, more stocks, for example, like like sort of like index fund, S&P 500 index fund, you dollar cost average, you will do very well. In fact, like the only people that do better are people that can time the market and invest right before there's like a major upswing, which is almost nobody. So that's the way to invest. You dollar cost average, meaning that you got to invest a little bit over time. And that's another way to take away that feeling of fear and protect yourself a little bit more. Invest a little bit. Invest a little bit in different types of assets and invest a little bit over time. And I'll give you another example. There's a very highly successful colleague of ours. He does the same thing we do, and super analytical guy. He also went through this kind of this analysis process period. He started back in, I think, 2010, which was like the prime time to start investing. And he was like, well, he bought a couple assets and he was like, I don't know if I should do any more. I'm going to wait. Like the market isn't great. People are saying there's going to be a downturn. He waited. It was 2011, 2012, 13, 14, 15, 16. He was waiting. If you remember, investing at those times was like the absolute best thing you could do. I mean, you killed it. Like you could literally like a monkey could invest during those times and make money. But he was just so scared to move.
Yeah.
And that's where, you just as you said, Nathan, you just, okay, let me invest a little bit. Let me do a little bit at a time and just go step by step by step. That's where, that fear, excuse me, that's when that you take that fear and you're like, look, I'm not going to make decisions according to the fear. I'm going to make decisions objectively. And this is what I'm going to do.
Yeah. And then especially I think it's a really relevant conversation to what's going on today, right? Especially in the real estate market, but specifically in multifamily. Just 2 years ago, we had kind of the height of the market. We had prices at all-time high. We had double-digit rent growth. Occupancy was high 90s. And now we're seeing more of a correction of that in the market where, prices are starting to come down. We're seeing markets with negative rent growth. We're seeing, vacancy spike in some markets. And so that creates just an emotional reaction for a lot of investors saying, hey, whoa, the market's volatile right now. It's going down. But if you look at kind of the long-term and cycle of real estate, those times to buy are really when the market is, correcting itself and is going to, come down from the peaks that it once had. So this is the canonical, zig when everybody zags. It's a lot easier said than done. But I guess the first step to that is one, knowledge, and then two is removing the emotion of, there's turmoil and there's hesitancy and no one really wants to deploy cash right now. But if you can find those opportunities that still make sense and buy at a good cost basis, especially in this market, when the market does correct and eventually does upswing, you'll position yourself in a really kind of really advantageous position.
So, yeah, a couple points there. The first is we're experiencing that as a company as well. Like, we sort of dollar cost average in our investments as well. We continue to buy through market cycles, but we buy, as I said before, you can buy in any type of market cycle. You just have to buy a deal that makes sense. But like, just as you said, we're experiencing those types of issues in some of our properties. And what are we doing? We're not going to, there are people that are just like, I'm going to drop all this and I'm going to sell and I'm out, and those are the inexperienced people. The people that are experienced will double down. And we've done that a lot. We were like, look, no, we're putting more money into this. We're going to improve it to a higher level. We're going to, make it really shine. We're going to like just really tighten asset management. We're going to do these things that, improve it a lot, and we're going to hold on to it. And that's the great thing about real estate is oftentimes, time will heal. Like you just have to hold on to something longer. Like if you've underwritten something for 5 years and you go through this cycle, you might have to hold it for 7. And, you hold it longer and you get you get those returns a little later, but that's okay because you're not losing. That's what you want to avoid. You want to avoid a loss. To that point, what you're saying is, the market has turned. There's a lot of fear. There's a lot of volatility. It's tumultuous. Now's the time to buy because the cost basis, meaning, the what you're paying for that property has dropped to such a degree that you've almost bottomed out. And how do you know when you're going to bottom? Like nobody really knows, but you look at the experts, right? You look at like Blackstone. They just put in $1 billion into a real estate, just buying an entire portfolio of real estate. Blackstone is one of the groups that all the institutions follow and see what they're doing because they have so much dry powder, they have so much capital to invest, and they have so many analysts that are looking at every aspect of the market and when is the right time, timing things properly. They're starting to buy. So when that happens, like other people are going to jump in. Luckily, we're already doing that because we've realized that if we do our due diligence, we understand where the property is, we understand where it's going. We have knowledge in that area. We have specialized knowledge. We can predict this happening. So we're buying, we're investing, we're doing that, and that's what you need to do. You need to be smart about how you move.
Yeah. I'm actually proud to be in the game, when things are going a little bit hairy, a little bit sideways. Because you're right, from like 2009 to 2022, everything in real estate was up and to the right. Like everything was, profitable, everything was a great deal. And now we're at the point where your time's a little bit tougher. And I always go back to there's this picture I saw a while ago, and it's like you don't want a knight in shining armor. You want a knight who's battle tested, who's, marred by sweat and blood and dirt, and has got his hands dirty in the battlefield, right?
Yeah.
That's really like what ideally as a true investor, you don't always want things to go right. You want to know how you perform in times when times are tough. That's exactly what David Goggins says too. He's like, anybody can go to the gym on a nice sunny day, but who's at the gym when it's raining and it's pouring and your car's broken down, right? Who has that motivation and that determination to keep moving forward even when the times are tough?
Yeah, yeah. You want to invest with someone, or you want someone at your side who has been through cycles, who knows what is going on. Yes, that's vitally important. Ideally, you don't want to go through it yourself. You want to leverage the knowledge of somebody else that has, so that you don't have to go through it, and you want to have faith and trust in that person, so you don't have to, feel those pains. Feeling those pains sometimes is the only way to learn, and I always think that way too. I'm like, hey, if I go through something, I'm like, well, this is, there's a reason for everything. I have to do the best I can, learn from the experience, and then move on. That's really the only way to think about these things. So, Nathan, I can tell you that out of all the times, Viking has been buying properties for almost 10 years now. I can tell you in that whole period of time, this is the first year I just want to acquire as much as possible. In the previous years, I was, Vic and we're like yin and yang in some ways. That you need that in a company. You need someone to push a little bit in growth, someone to pull a little bit so that we're in the right place. And I was the one like pulling a little bit. Now we're both in super growth mode. And this is the first time I've been there because I'm seeing what's out there now. I'm seeing like prices per unit of these assets are where they were back in 2017 in some locations. Like it's ridiculous. And, cost basis is where it's at. So, you may not cash flow for a little while, but that's okay. But if your cost basis is so low, it's as things improve, it'll get better and you're going to sell at some highs. Because we all have had those experiences where we're looking back and we're like, damn, I wish I purchased that property at that time. I would have made a killing. This is the time where you wish you would have purchased.
Yeah. I'm even seeing deals on the acquisitions front that are being brought to market. And the broker is even openly stating that the new Whistler price, the new guidance pricing, is lower than the current seller's all-in basis, meaning that the seller is inevitably going to take a loss on this deal, but they have to sell it. It's almost like a guaranteed discount. So,
And you're not taking those sometimes, right? You're like, it doesn't make sense. You're like, I don't care if the seller's taking a loss. It still doesn't make sense to me.
yeah,
Like that's where the market is.
yep. Yep, that's really your point. Like not every cost basis deal is a great deal. It's a great cost basis, right? Some
Yeah.
some deals are struggling and they're struggling for a reason, but you want to really pinpoint, all right, among those that are distressed, what has the highest potential and the kind of the strongest fundamentals for future upside, right?
Yeah.
And that all goes back to kind of why they're in distress. Why is it a market condition? Is it a sub-market condition? Is it a property level issue? If you can drill down on that, I think it's a really tremendous upside for your kind of future sales price.
Yeah.
So, Rob, you talked a lot about kind of fears and hesitancy. Can you talk a little bit about how to overcome fears if you are experiencing them or when you're experiencing them?
Yeah, I think, just as we discussed, it's about knowledge, about really gaining as much information as you can about the particular area in which you're investing in. Not only if we're talking about real estate investments, the geographic area, the type of class of asset, people that just talk to people that have been there before, have done that. I think it's just obtaining that knowledge is really key. And once you do that, and once you have your savings in place, as I mentioned previously, then you can invest knowing that you're just dollar cost averaging. And that takes a lot of fear away because you're being very objective about it. You're not being emotional.
Yep, totally. For me, I was really focused on the cost of inaction. A lot of people focus on, hey, if I make this investment, what's the worst that can happen? What's the best that can happen? But for me, I always go back to, all right, what if I don't do anything? What if I just hold my capital and sit on the sidelines? And that for me, for some reason, it motivates me to get into action faster than any kind of opportunity that's presented to me. Is I can't sit on the sidelines and expect to grow wealth, right? I can't hold my cash and wait for a year, 2 years, 3 years, 5 years to pass by and have nothing, no real change in my wealth. That will inevitably get me out of the bed, so to speak, in the morning and get to work.
Yeah.
Awesome. So, Ravi, we talked about, fears. We talked about, having a plan, moving through. Any kind of last bits of wisdom for someone who might be a little bit hesitant to invest, or someone who has capital to deploy but doesn't know where to put it? Anything else they can kind of glean from your experience?
Yeah, I just to recap, really, I think it's very important to have that fundamental knowledge base. Number one. Number two, it's really important to tap into people that are in the know, that have been there before, that have done what you want to do. You also want to make an investment plan, understand, how much money you want to save, you want to put aside, how much money you want to invest, so that you understand that even if you were to lose that investment, worst case, you're still okay because you have enough to put aside. And then you just take those small steps. You do small investments, and as you get more comfortable with what's happening, you'll invest more and more. As you gain more knowledge, you'll invest more and more. But just start small. There's no issue with that. And even if there's a deal that says, hey, there's a minimum amount, call the sponsor. Just say, hey, look, I'm just starting off. I want to start smaller. That's fine. Like many of them will just accept it. So it's okay if you want to start even below what they're asking for. I've done that multiple times. That's my advice. And just keep looking out there. Don't be so scared you're holding on to your funds and doing nothing with it, because just as you said, Nathan, you're not going to grow. And you talk to the people that are very wealthy. Just talk to your circle of friends, colleagues that are very wealthy and well off, and ask them if they've made mistakes. I mean, I would guarantee like all of them have made mistakes because they are taking risks. Mistakes happen. It's just going to happen. But if you do it intelligently, it's an asymmetric risk reward, right? You're going to get hit, but you're going to get much more reward than you're going to get hit. So keep that in mind.
Yeah, even Dwayne "The Rock" Johnson, anytime I can quote him is a pleasure. But Dwayne said, he was like, the reason I'm so successful is because I've had so many failures. It's not necessarily all the successes that made him successful, but it was all the times that he put himself out there and learned and tried and continued to get better. He's like, I probably had more failures than most people on earth. And that's the thing. When people think about a successful person or a successful investor or a wealthy person, they think, oh, they got it lucky, or they never had the struggles that I went through. But it's really those that are able to kind of conquer their own fears, conquer their own kind of mental game, that are really the ones that are really kind of push through and find success.
Yeah, absolutely. I'll end on one last story. There's a mentor of ours, super successful, the nicest guy, completely honest, transparent. Like I've invested with him. Many people have. When he opens up a deal, like it literally fills up in minutes. I spoke with him about his past, and he had a couple deals that went south. One where everybody lost every penny of their investment. And I think it was a pretty sizable investment. He invests in shopping centers. So there was like, shopping center, things were looking good. I think it was about 20 million that he was looking to raise. He raised the full amount, closing the deal. And the credit tenant that was supposed to occupy the biggest space in that shopping center decided they were no longer interested and just backed out of that lease. And they signed it. They just said, sorry, I'm not doing it. Just everything went down. He couldn't pay. He couldn't pay the mortgage. And then he had to turn in the keys, lost every penny. That guy is one of the most successful guys that I've met, because, he took that, he learned from it. His investors doubled down with him because they trusted him. He's so honest, and he's doing really well now. So it's just another story of, like this stuff happens. It happens to everyone. You don't want to be the one on the end of that, getting hit that way. But at the same time, as long as you're doing the things that I mentioned previously, you're knowledgeable, you're taking the right steps, you're acting intelligently, you're going to avoid that.
Great. Awesome. Thanks, Ravi. I appreciate it. Everybody out
Nick.
there, get in the game. Reach out to us if you have any questions, and we'll see you on the next episode.
Thank you.
If you like this podcast, please hit subscribe or a thumbs up, and we'll see you next time.